And now, the moment you've been waiting for all week, Courtney Smith's weekly video newsletter, TradeSmith.
And they're off and running for another year of fantastic profits. Welcome, everybody. Happy New Year. In fact, happy, prosperous New Year. I'm really excited to get going on another year of TradeSmith. We crushed it last year. I think we might be able to do better than that this year. Hey, everybody. But, of course, there's no possible way that we can do better than this. This, of course, is the most important thing in today's presentation. All right, let's take a look here. Hey, everything was going along smoothly, nice and quiet, good, solid type of action, and then whammo, Friday, not a good look. First of all, notice how the purple predictor is below the price action. That is a bearish sign. The fact is, we didn't make a new high for almost 2 weeks, a week and a half to 2 weeks. We're supposed to be making new highs. If this is a bull market, we're supposed to be making new highs. So that's also not a good look for this market at all. So this is not good price action. Now, wait till we get to the seasonality and I'll tie this together. Here we see that the bullish pressure, the green line up top there, is still much, much more bullish than the red line, showing much more bullish pressure than bearish pressure in the marketplace. But nonetheless, I think we're going to stagger here a little bit. Stick with me. Nasdaq, similar situation. Okay. Seasonality, bullish. But if we break below that 148 level, I'll switch it from a bull signal to a neutral signal. But right now, we're still in bullish seasonality. Now, look at this chart right here. Notice in January that we see a dip in the marketplace, either midterm elections, which would be the blue line, and that's the one we should try to be looking at, or a midterm year after a positive post-election year, which is what we had. That's the black line. But you can see they're very, very similar. The point is, January is not a great month, and so it looks to me like we might see that dip. Now, how big of a dip? Well, according to the seasonality, on average, it's only going to be about 2%, which is no big deal. But that's an average, and of course, you know, nobody drowns in a river that has an average of 6 inches. Except, oops, at some places it's 1 inch deep, and other places it's 10 feet deep. So we could see maybe a 5% correction here. So how do we play it? We keep on plugging away. We don't have the final signal that we're going to see that yet. If we do, I'll probably buy an option on SDS to hedge the portfolio. I'm going to wait 1 more week, though, because this first week in January tends to be very bullish, and then we start to crap out in the middle of after the first week in January. So that's my scenario right now. The yield curve, as I've been mentioning, is not really all that great for us right now, but it's okay. It's just going to keep a cap on gains this year. Asset allocation kind of slipped back a little bit. Money flowed out of the stock market and back into the bond market. So that asset allocation did not help us this week. Stock market RISKDICATOR, really nothing changed there. Really didn't go anywhere. Global shares looked really good. Better than the U.S. They outperformed the U.S. market this week. Of course, mainly because of Friday. Bonds have rallied back, but, you know, I can't get excited about trading these bonds because look at how sloppy that price action is. Wide swing. We got about a 5-point trading range here, and you know what? It's just safer to not do anything when you see that kind of action. Bond, now, this is the interesting thing. Take a look at this chart very, very closely. The green line is interest rates, and you can see they hooked down a little bit. But the other 3 lines from the top, gold, that's the gold line. The blue line is the 10-year treasuries in Germany, and the bottom line is the CRB index. All of those are still pointing for higher interest rates at the 10-year level. So we have to take that clearly into mind and think that this dip, this rally we have here, remember a rally in bonds means lower interest rates. It suggests that this rally is not going to go make new highs, but is going to turn around and start going back down again, thus giving us higher interest rates. So this is a real critical factor. Well, look at what happened to the dollar. Crapped out. Here's that big trading range we talked about. That big head and shoulders we talked about. And it's cracked down. And this would suggest that we could drop about 5% in the dollar. Wow. Gold, conversely, skyrocketing higher on the back of that weak dollar, breaking to new highs. Unfortunately, we're not in this trade because there was really no retracement and no low-risk entry point. And, of course, even though it was easy to see we might go higher, and, in fact, we've gone higher for like 7 straight days, I always need to have a low-risk entry place. I need to have a place where I can put a protective stop loss so I don't get hurt. I need to protect cash. That's more important than making money. Now, our indicators are all bullish for gold, so that's also positive here. So I got to find a way to get long gold here. Oil, new highs. I guess I got to throw in the towel and say, looks like we're going to continue to move higher here. All right, that's it. You know what to do, everybody. Very fascinating price action. So look for a little bit of shake and bake here in the market. Look for it to go down a little bit. And, of course, you should subscribe to get all the great trades. All right, that's it for you. Freebies, that's it. We've had it for you. And we will talk to you next week.